My dear students, welcome back to our channel. In this video, I will be explaining the MBA second semester subject Financial Management as prescribed by JNTUH and other universities of Telangana. We will go through the important questions and answers one by one. Let's begin with a quick revision. Unit 4 first important short question is: what is dividend policy? Dividend policy means the guideline a company follows to decide how much profit should be given to shareholders as dividends and how much should be kept in the business for future growth. In simple words, it is about sharing the cake, profit, how much goes to shareholders now, dividend, and how much is saved for later, retained earnings. A company with a high dividend policy pays more to shareholders, which keeps them happy but leaves less money for growth. On the other hand, a low dividend policy means more funds are kept for expansion, but shareholders may feel dissatisfied. Example: suppose a company earns 10 lakh rupees profit. It decides to give 4 lakh rupees as dividends and keep 6 lakh rupees for expansion. This rule of deciding how much to distribute is called its dividend policy. Thus, dividend policy balances shareholder expectations and business growth needs, helping in long-term financial planning. Next important short question is: 2. What is rights issue? A rights issue is a way for a company to raise extra money by giving its existing shareholders the right to buy more shares before offering them to the public. In simple words, the company asks its current owners, "Do you want to buy more shares at a special, usually lower, price?" This helps the company raise funds and also gives shareholders a chance to increase their ownership. Example: suppose you own 100 shares of a company. The company announces a rights issue of 15 at 80 rupee per share, current market price 100 rupees. This means you can buy 20 extra shares, one new share for every 5 owned, at 80 rupees each. This is a benefit because you get shares cheaper than the market price. Thus, a rights issue is beneficial for both the company, gets funds without taking loans, and the shareholders, get more shares at a discount. Next important short question is: 3. What are the major forms of dividends? Major forms of dividends. A dividend is the part of profit a company gives to its shareholders as a reward for investing. Companies can pay dividends in different forms. The main types are: 1. Cash dividend, the most common type. Shareholders get money directly. Example: if a company declares a 5 rupee dividend per share and you own 100 shares, you get 500 rupees in cash. 2. Stock dividend, bonus shares. Instead of cash, the company gives extra shares. Example: a 10% stock dividend means if you have 100 shares, you get 10 more shares free. 3. Property dividend, rare. The company gives assets, like goods or property, instead of money. 4. Scrip dividend, the company issues promissory notes to pay later when cash is available. 5. Bond dividend, shareholders get bonds instead of cash, which can earn interest. In short, dividends can be in cash, shares, or other assets, but the goal is always the same: to reward investors for their trust in the company. Next important short question is: 4. What is meant by dividend valuation? Dividend valuation. Dividend valuation means finding the value of a company's share based on the dividends it pays to shareholders. The idea is simple: if you are an investor, the worth of your share depends on the money, dividends, you expect to receive in the future. The most common method is the dividend discount model, DDM. It says: value of share, P is equal to expected dividend, D, required rate of return, K, growth rate, G. Example, suppose a company is expected to give a dividend of 5 rupee per share, the required return is 12% and growth in dividend is 4%. P is equal to 5, 0.12, 0.04 is equal to 50.08 is equal to 62.5 rupees. This means the fair price of the share is 62.5 rupees. In short, dividend valuation helps investors decide whether a share is cheap, fair, or overpriced, making it an important tool in financial decision-making. Next important short question is 5. What are Lintner's views on dividend policy? Lintner's views on dividend policy. John Lintner studied how companies decide their dividend policy and gave some important insights. According to him, companies do not change their dividends suddenly. Instead, they follow a stable and cautious approach. His main views are: 1. Target payout ratio. Every company has a target dividend payout, for example, 40% of profits. 2. Stability. Companies do not increase or decrease dividends quickly, even if profits fluctuate. They prefer slow and steady changes. 3. Past dividends matter. Managers consider last year's dividend before declaring the new one, as sudden changes may confuse investors. 4. Partial adjustment. If earnings rise, companies adjust dividends gradually, not fully in 1 year. Example: if a company aims to pay 40% of profit as dividend, but profit jumps suddenly, it will not double the dividend immediately. Instead, it will increase step by step. In short, Lintner explained why dividends remain stable over time, giving confidence to investors. Next unit 4. Long questions. First important long question is: explain the relevance and irrelevance theories of dividend, Walter, Gordon, and hypothesis. Relevance and irrelevance theories of dividend. In financial management, there is a big debate: do dividends matter for the value of a company? Some experts say yes, relevance theories, while others say no, irrelevance theory. Let us understand the main theories. 1. Walter's model, relevance theory. Walter said that the value of a company depends on how profits are used. If the company earns higher return, R, than its cost of capital, K, it should retain profits instead of giving dividends. If RK, it should pay dividends, as investors can earn more elsewhere. Example: if a firm earns 20% return, but investors expect only 12%, better to reinvest. 2. Gordon's model, relevance theory. Gordon supported dividend relevance and gave the bird-in-hand theory. He said investors prefer certain dividends today rather than uncertain future capital gains. High dividend payout increases investor confidence and company's value. Example: a shareholder feels safer getting 5 rupee dividend today than hoping for 7 rupee profit in future. 3. Modigliani and Miller, hypothesis, irrelevance theory. Argued that dividend policy does not affect the value of a company. The company's value depends only on earnings and investment decisions, not on whether profits are distributed or retained. If investors need cash, they can sell shares. If they want to reinvest, the company can issue new shares. Example: whether a company pays dividend or reinvests, the shareholders' wealth remains the same in perfect markets. In summary, Walter and Gordon is equal to dividends are relevant, they affect company's value. is equal to dividends are irrelevant, they don't affect company's value in perfect markets. This debate helps managers decide whether to distribute profits or reinvest them. Next important long question is: 2. Discuss the factors determining dividend policy of a firm. Factors determining dividend policy of a firm. Dividend policy means deciding how much profit should be given to shareholders as dividend and how much should be kept in the business for future growth. Every company wants to balance investor expectations with financial needs. Let's understand the main factors that influence dividend policy. 1. Earnings of the company. Dividend can only be paid when a company earns profits. A stable and growing profit means regular dividends. Example: Infosys declares regular dividends because of steady profits. 2. Liquidity position. Even if a firm earns profit, it needs cash in hand to pay dividends. If cash flow is tight, dividend payout may be low. Example: a real estate firm may have profits but little cash, so it delays dividends. 3. Stability of earnings. Companies with stable earnings can follow a consistent dividend policy. Example: FMCG companies like Hindustan Unilever give regular dividends as their income is steady. 4. Growth opportunities. If a company has many future projects, it may retain profits to reinvest. Example: startups usually do not pay dividends, they reinvest to grow. 5. Shareholder preferences. Some investors want regular income, prefer dividends, while others are okay with capital gains, prefer retained earnings. Example: retired investors prefer dividends, while young investors may prefer growth. 6. Legal restrictions. Companies must follow laws under the Companies Act and cannot pay dividends out of capital. 7. Taxation policy. If dividend income is taxed heavily, firms may prefer to retain earnings. 8. Market conditions. In uncertain markets, companies prefer to retain profits instead of distributing them. In summary, dividend policy depends on profits, liquidity, growth needs, shareholder expectations, laws, and market conditions. A wise company balances both, rewarding shareholders and keeping funds for future growth. Next important long question is: 3. Explain the different forms of dividends: cash dividend, bonus shares, share splits. Different forms of dividends. When a company earns profit, it has two choices. 1. Distribute profit to shareholders as dividend. 2. Retain profit for future growth. Dividends can be given in different forms. The most common are cash dividend, bonus shares, and share splits. Let's understand them in simple words with examples. 1. Cash dividend. The most common type of dividend. Here, the company directly pays cash to shareholders from its profits. Shareholders usually receive it in their bank account. Example: Infosys announces a cash dividend of 20 rupee per share. If you own 100 shares, you will get 2000 rupees in cash. Easy to remember, cash dividend is equal to direct money in your pocket. 2. Bonus shares, stock dividend. Instead of cash, companies give extra shares free of cost to existing shareholders. This increases the number of shares held but does not change the total value of investment immediately. Example: a company declares a 1-1 bonus issue. If you have 50 shares, you will now get 50 more for free, making your total 100 shares. Easy to remember, bonus is equal to gift shares without spending money. 3. Share splits. A share split means dividing each share into smaller parts to make them affordable and increase liquidity in the stock market. It does not change the total value of investment, only the number of shares increases and price per share decreases. Example, a company announces a 2-for-1 split. If you had 10 shares priced at 1000 rupees each, after split you will have 20 shares priced at 500 rupees each. Easy to remember, split is equal to same pizza cut into more slices. Conclusion. Cash dividend gives immediate money. Bonus shares reward shareholders with more ownership. Share splits make shares cheaper and more tradable. Together, these dividend forms help companies balance shareholder satisfaction and long-term growth. Next important long question is: 4. What is dividend valuation model? How are dividends related to the value of the firm? Dividend valuation model, DVM. The dividend valuation model, DVM, is a method used to find the value of a share or firm based on the future dividends that shareholders expect to receive. The logic is simple. The value of a share today is equal to present value of all future dividends the shareholder will get. Since dividends are the actual return investors receive, this model directly links the firm's dividend policy with its market value. Formula of DVM. For a company with stable dividend growth, the Gordon growth model, a type of DVM, is used. P0 is equal to D1 kg, where P0 is equal to current price of the share. D1 is equal to expected dividend next year. K is equal to cost of equity, required return of shareholders. G is equal to growth rate of dividends. Relation between dividends and firm value. High dividends increases investor confidence, share price rises, firm value increases. Low dividends, but high reinvestment, may still increase value if profits are reinvested wisely and growth, G, is high. If the company does not pay dividends and also fails to grow, the share value falls. Example. Suppose a company is expected to pay a dividend of 5 rupees next year. The required return, K, is 10% and the dividend growth rate, G, is 4%. P0 is equal to 5, 0.10 0.04 is equal to 50.06 is equal to 83 rupees and 33 paise. This means the fair price of the share is 83 rupees and 33 paise. If the market price is lower, investors will buy it. Conclusion. The dividend valuation model clearly shows that dividends are the backbone of share value. A firm's value depends on how much dividend it pays and how fast those dividends grow. For investors, both dividend income and growth prospects are important in judging a company's worth. Easy tip to remember. Dividends today plus growth tomorrow is equal to value of firm. Next important long question is: 5. Write a note on dividend policies of Indian companies with examples. Dividend policies of Indian companies. Dividend policy means how a company decides to distribute its profits between two things. 1. Dividends to shareholders, cash bonus shares, and 2. Retained earnings for future growth. In India, dividend policies vary depending on the company's size, profitability, growth plans, and industry. Types of dividend policies followed in India. 1. Stable dividend policy. Companies pay a fixed dividend every year, even if profits fluctuate. Example, ITC Limited pays regular and stable dividends because investors, especially retirees, expect steady income. 2. Constant payout ratio policy. A fixed percent of profits is paid as dividends. Example, Infosys pays around 30-40% of its profits as dividends, so if profits rise, dividend rises too. 3. Residual dividend policy. Dividends are paid only after meeting investment needs. Example: many startups or growing companies like Zomato or Paytm usually don't pay dividends as they reinvest earnings into expansion. 4. Hybrid policy. Mix of stable dividend plus extra dividend in good years. Example: Reliance Industries gives moderate regular dividends and occasionally adds bonus issues or extra payout when profits are high. Dividend trends in India. Banking and FMCG companies, HDFC Bank, Hindustan Unilever, prefer regular dividends to attract stable investors. IT companies, Infosys, TCS, Wipro, follow payout ratio policy, balancing dividends and reinvestment. Growth-oriented companies, Adani Group, Zomato, Paytm, pay low or no dividends to focus on expansion. Conclusion: Indian companies use dividend policy as a tool to build investor confidence, stable dividends, support future growth, low dividends, more reinvestment, and maintain a balanced, hybrid policy. Easy tip to remember: ITC is equal to stable. Infosys is equal to ratio-based. Reliance is equal to hybrid. Startups is equal to no dividend. Thus, dividend policy in India depends on the nature of the business, investor expectations, and growth strategy.